Want to know how you can claim up to $162,000 as a personal tax deduction whilst increasing your retirement savings in super? In this video, I'll explain how you can claim a personal tax deduction for super contributions so you can get tax dollars back from the Australian Tax Office. My name's Chris Vlahos and I'm an authorised financial advisor with over 10 years of experience helping clients build and protect their wealth to achieve financial freedom. In this video, I'll provide general information only, and this does not constitute financial advice, so you should read the disclosure below. And if you enjoy the video, leave a like and subscribe to the channel. Let's dive in. Each year, you can make a personal contribution to your super fund, which you can claim as a personal tax deduction. The limit is $30,000 less any employer contributions, such as super guarantee and salary sacrifice contributions. There are age restrictions which can prohibit people from making these deductible contributions to super. If you are between ages 67 to 75, you need to meet a work test by being gainfully employed for at least 40 hours within a 30 consecutive day period, and you cannot make personal super contributions 28 days after the month in which you turn 75. So let's look at an example of how this works. Let's say we have 55-year-old Clyde who is in a management position and earns $180,000 plus super. In FY25, his employer will pay super guarantee of 11.5% of his salary, or $20,700 to his super fund, which means he can personally contribute $9,300 to super and claim it as a tax deduction. He would reduce his personal tax by $3,627, pay 15% tax on the contribution inside super of $1,395, and so his overall tax saving would be $2,232. And if your total super balance is less than $500,000 on the previous 30 June, you can also carry forward any unused concessional contributions from the previous 5 financial years by contributing up to the unused amount and claiming it as a personal tax deduction in that financial year. You can check your MyGov ATO portal to see whether you're eligible to make these carry forward contributions, and also to check what your unused concessional contribution amount is. So if Clyde earned $180,000 plus super over the last 5 years and he did not make voluntary contributions in addition to his super guarantee, he would have $50,900 of unused concessional contributions. If Clyde personally contributes this $50,900 to super and claims a personal tax deduction, he will reduce his personal tax by $19,438 and pay super tax of $7,635. So his overall tax saving would be $11,803. Some key points with this strategy. If you wish to make a personal contribution and claim a tax deduction, you need to lodge a notice of intent to claim a personal tax deduction form with your super fund. They need to receive this form, acknowledge that it's been received and processed before you can lodge your personal tax return. If you lodge a tax return before lodging the notice of intent form, it will be disallowed and you will not be able to claim the personal tax deduction. So it's important that you lodge this form first before your tax return. When you carry forward unused contributions from previous years, the capacity will be used up from the oldest year up to the most recent, and you're only able to carry forward from the previous 5 financial years. So if you have unused capacity from 6 years ago, you will not be able to claim this amount as a deduction. This strategy is also extremely beneficial if you have a high level of income or if you sell an asset and realize a significant capital gain. Let's say Clyde and his wife Bonnie bought an investment property for $500,000 10 years ago and recently sold the property for $852,400 net of expenses. They have therefore realized a capital gain of $352,400. Assuming Bonnie has earned $120,000 plus super over the last 5 years and hasn't made any additional contributions, she would have $88,100 of unused concessional contributions. Clyde and Bonnie both decide to maximize their unused concessional contributions. Clyde would reduce his personal tax by $23,923 and Bonnie by $34,757, while Clyde would pay tax inside super on the contributions of $7,635 and Bonnie of $13,215. Clyde would reduce his overall tax by $16,288 and Bonnie by $21,542. This is a combined tax saving of $37,830. Without superannuation tax planning, capital gains tax is $75,364, but with advice, capital gains tax is reduced to $16,684. The other key benefit of this strategy is they have now put more capital into the low tax super environment, which they can later convert into a tax-free pension to help them fund their retirement. This strategy is also available for people who have recently moved to Australia and become tax residents. Even if they haven't been earning an income over the last 5 years, they can still carry forward unused concessional contributions from the previous 5 financial years and claim it as a personal tax deduction. Before doing this strategy, you should speak with a licensed financial advisor like me, because the limits are updated every few years and only licensed financial advisors can provide super contribution advice in Australia. And keep in mind, you can only access your super when you meet a condition of release, such as turning age 65, but I'll provide more information in another video. So there you have it. That's how you can contribute to your super fund and potentially lower your personal tax by tens of thousands of dollars. If you're looking for advice to build your own financial plan, you can click on the link below, book a free consultation. And if you enjoyed the video, again, please leave a like and subscribe to the channel for more. Thanks for watching.